So if the deal doesn't even hit the pref rate, you can have 14 hurdles after that. But if it's not in the pref rate, you're not going to get any of that windfall. So just find a good deal, keep the waterfall simple, and people will come back to you.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you're enjoying the show, do me one favor and leave us a rating and review. We want to hear what you love about the show, but also anything we can do to make it work harder for your investing goals. And if you haven't done so already, make sure you hit the subscribe button so you don't miss an episode. And we got a great show today. We're going to be talking to Mark Purtell and Joe Harriman. All right. So Mark Purtell and Joe Harriman are with CTC Wealth Management. This is a real estate business investing as co-GP and LPs in the multifamily space. Now, they are open to primary, secondary, and tertiary markets, looking to invest in workforce, value add, stabilized, and ground up deals. Let's welcome to the show, Mark Purtell and Joe Harriman.
Thanks for having us.
Thank you.
Absolutely. Absolutely. Listen, guys, great to have you on. Why don't you take 2 minutes and fill in some of the gaps in your background?
Go ahead, Mark.
So I've been with CTC for 22 years. I started out on the trading side, and about 3.5 years ago, transitioned full time to the real estate side. Personally, I bought my first 3-flat when I was 22 with a FHA loan, and been doing real estate kind of on the side before going into the fund structure.
Oh, yeah, my name is Joe Harriman. I've been with CTC for 17 years now. Again, started on the trading operations side, but helped found the real estate investment company back in 2017. Currently COO of CTC Capital Management, which is the SEC registered investment advisor for all of our funds. We started our real estate company back in 2017 really to capitalize on some existing multifamily relationships we had, and to pull capital together to get good economies of scale in investing and be able to negotiate good terms and focus on our multifamily relationships.
No, I love it. Well, listen, I'm excited to talk to you today. And before we dig too deep into things, I do want to let everyone know that, you're here on behalf of CTC Wealth Management, but the views that you're going to express are your own personal views. So this is not necessarily a reflection of CTC and their opinion. This is you guys. And we also want to tell people, again, this is for education purposes. By no means should you run out and make decisions based on anything you hear on this podcast. So do your own due diligence. This is more directional and education focused, but this is not, investing advice. This is not something that you need to go and implement right away without doing your own due diligence. So with that said, guys, give us a little more context of what CTC Wealth Management actually is and does. Like, do you guys consider yourselves a private equity firm? Do you consider yourself something else? How do you frame that up?
Yeah, so we run a series of pooled investment vehicles, so essentially closed-end, call it private equity funds. As I mentioned, we formed the first one in 2017. We currently have 100 million in assets under management across 4 different funds. We've made 40 investments throughout these funds. We have 14 exits, primarily IRR driven. We target kind of the mid-teen IRRs in our investing. Our recent fund launch, we launched our 4th fund in November of 2022, last year. That's focused on investing primarily as co-GP in multifamily value add deals. It's mostly looking at the workforce housing area. So we don't do a lot of Class A development. We do have the option to allocate some of our fund capital to non-multifamily deals. So we're a very opportunistic group. We look at, what's happening in the market. Though our core focus is value add multifamily, we've done deals in self-storage, student housing. We've done some hotel conversion investments. So we're very opportunistic. We look at pretty much anything. And at this point, in our most recent fundraise, we've yet to deploy capital. We've been, pretty cautious over the past several months. So we're excited about the opportunity going forward. We think there could be some pretty interesting investment deals that hit the market, and we're, ready to deploy capital.
No, I like that a lot. So when you mentioned kind of that co-GP and LP model, what I'm hearing and what I imagine listeners are thinking is that, okay, you're going to come in and partner with us on these deals. So just explain that a little bit more. Are you all signing on the loan? Are you really a part of the general partnership team? Are you involved in decision-making processes and things like that? What does that model actually look like?
Yeah, we look to work with primarily emerging operators. The operators on a couple deals and they're looking to scale. Maybe they use family and friends money, maybe they use their own money, and they're at the point where they're ready to start really ramping up. Generally, the limitations for these operators are find isn't really sourcing deals, it's sourcing that co-GP or equity to do it. And so what we use is with our current fund, we use that as the signer on the debt, and then we'll also invest up to 95% of the GP capital. So what that allows an operator to do is then go take their 5% of the GP slice plus our 95%, and now they have the GP slice, which is typically 10 to 15% of the deal. With that in hand, now the operator can go out and say, hey, look, Mr. LP or Mrs. LP, I've got the capital to do the GP. I've got a signer on the note. All you need to bring in is the equity. And then so that combined with a deal, and this operator now has done from 10x the number of units they're doing on their previous deal because they have the backing of a group like us.
Yeah, I love that because I think it opens up the door for many operators, right? If you can find deals, if you can, find opportunities, but you need capital and you need help maybe signing on that loan or again, getting everybody excited and involved because nobody wants to be the first one to commit, right? I mean, they want to see that you've got some investors on board. They want to see that other people are interested in this deal. So that's a great way to get everybody excited about it. Talk to us about that process. What's your vetting process? What are you looking for in an operator? What are you looking for in a deal?
We're really looking for an operator who's got the experience to know how to run a business. Some of the operators we've worked with, they were in a different non-real estate business, but they proved successful there. They made a transition to real estate, or they're someone who's done real estate deals and has the ability to grow a business through property management, through operational efficiencies, through sourcing off-market deals, and they've kind of got that key, but they just want to expand. So when they come to us, bring us a deal and show us a good deal, and then we'll look at you, kind of secondly. But if it's a good deal, we're definitely open to exploring, and we can talk about next steps after that. But the key is, find a deal, show that you've done this before to some capacity, and we're happy to talk with you.
Yeah, I think the interesting part of what you said was one, the ability to run a business. So it doesn't necessarily have to be a deep real estate background, but you need to be able to demonstrate that you can run a business. You have a sense of what you're doing in this space, but also that it's a good deal. And I have a belief that people say, "Hey, find a good deal and the money will come," and I push back on that notion because one person's definition of a good deal may not align with someone else's definition of a good deal. Beyond that, I also think that it may it may provide almost too much confidence that people don't have to really work to go out there and find money or to put the deal in front of people that is just magically going to show up. So I don't like that phrase, but I want to get back to the good deal part because again, you all look at stuff, you have partners who are sending you deals all the time. How do you define good deal without, putting up hard rails? Again, I know you see deals where that operator believes it's a good deal, and I'm sure that there are people who think it's a good deal, but they're deals that you've turned down because you've had some concerns. So talk to us about some of those red flags or those concerns you have when it comes to identifying a good deal.
We really want to see some type of value add component. Maybe it's a mismanaged property, maybe it's a unit that hasn't been renovated in 20 or 30 years, across the board for the property. Maybe it's just an owner who's just said, hey, I tried it, it didn't work out, I'm done. Or maybe there's some other type of distress situation where the bank took it over and they got to get rid of it. So every deal's got to have some type of story to it that there's a reason why it's a good deal. Anybody can look at the rents and look at the market and say, okay, that's fine. But we weren't really looking for some type of aspect of the deal where we can say, okay, here, this is the 1, 2, or 3 key items that is going to make this property work.
I'll also add to that, and then also kind of dovetail the due diligence side is it's super important, especially on these heavy value add deals, that you have a GC that is extremely competent and knows, has his pulse on that submarket and, can bring in the right subs. It's really, we look at the whole team, the whole operating team, and it's even the outsourced property manager as they bring that in. We like to talk to them to make sure that they have the experience and confidence that they can achieve, the business plan that was put in front of us.
I think it's really important to understand, right? So understanding the business plan, the value add approach, but also getting that validation that yes, we've got good people, we've got the plan on paper, we have the good right people who can execute this plan, and that's something I think sometimes people they overlook, right? You put the numbers in a spreadsheet, especially for newer operators, right? They put the number in a spreadsheet. Maybe they found a property management company or they found one person they really like, but they haven't necessarily built out kind of the team that they feel confident with or have vetted them and to really push them and make sure that they truly do believe in a deal. There are many LP investors who are looking to invest in real estate and maybe they're not ready to drive or lead the deal, or maybe they don't want to do that, but they're looking to evaluate opportunities to park some of their capital and invest. Talk to us about kind of your process. Like, what are some of the things you're looking for, and what advice would you give to anybody looking to invest passively into a syndication deal?
When we look at a deal, we look at four main aspects. One, we'll look at the property. As mentioned, we want to see a good seller story. We want to see a reason why this is a good deal. Two, we're looking at the submarket. We want to see, diversified economic drivers there, different companies, growth of population. Three, we're going to look at the promote structure, or what type of waterfall that operator is offering and how we can work with that. And then four, we're looking for the operator to be someone, as mentioned, who can run the deal. So those four aspects are kind of the high level of what we're going to drill into when we look at a deal. Frankly, we like to say that all four are going to be great, and they're excellent across the board. But realistically, we're looking for three greats and one good, and that's going to do it. You're just never going to like every aspect about every deal. So I don't want to say good enough, but maybe great with a little asterisk next to it.
I think it's a good clarification point, though, because some people are looking for the perfect deal, and we know that the perfect deal really doesn't exist, not in its current form. Maybe you can create the perfect deal or the great deal, but it's really hard to find that perfect deal. So, to your point, you're looking at four attributes. You're looking at the property itself, the sub market. You're looking at, you go to the promote structure. Well, let's just call it the deal structure, right? Or the equity structure, and then you're looking at the operator. And you're looking for three of those to be great and maybe one of them good. You probably don't want anything to be bad, right? So you want three of them great, one good, and that's going to give you comfort in the moving forward the plan. Out of these four, is this like an even weight? Is there one or two of these that you lean more heavily on? How do you approach that?
It's really kind of specific by the deal, depending on how much risk we see in the deal. We might weigh one a little bit more. Clear example would be a development deal. That operator weight's got to be a lot more heavy than relative to, say, the promote or the project type. Because the operator drops the ball, that project's not even getting on the ground. So that's one example where we're going to lean a little heavier towards one versus another one.
Yeah, makes a lot of sense there. Let's go back to kind of CTC Wealth Management, right? So as you all are looking at kind of the current landscape, the economy has started to shift, interest rates continue to move. How are you preparing yourself for the future?
I mean, like I mentioned, we have a lot of dry capital right now in this fund, and we're just, we're actively underwriting things, and we're willing to invest in the right deals, but we're being more cautious, just like kind of, as rates are, starting to settle in, the banking, banking crisis, the current one, we're, keeping a close pulse on that and what that's going to do to commercial real estate lending going forward. It's going to be very important, when we look at kind of the structures of the deal, to look at what kind of debt they're putting on this deal. Are the debt terms aligning with the business plan, making sure that you have, if it happens to be a floating rate, that, try and get a cap put on there if possible. It would be expensive these days, but you have to really pay attention to what kind of debt and what your banking partner, who your banking partner is. It's more important these days to take a look at that stuff as well.
Yeah, I mean, the loan has obviously been the big talk over the last, few months here with the interest rates, shooting up as much as they have, and those rate caps, whether they're in place or not, having a big impact of, what's available in the market right now. What other changes have you all seen or have you made to your process, say over the last 6 to 12 months, based on kind of the economic changes, or maybe there are deals that you would have done last year that, maybe you wouldn't do today?
Far as the debt aspect, it's kind of self-correcting in itself that as interest rates go up, the debt service coverage ratio to hit that same one, you need, more equity in a deal. So, that's one aspect where, in a sense, these projects are creating lower leverage at the expense of higher interest rates. So in that regard, you could make the argument these deals are a little more conservative from a leverage standpoint. So that's something that we're always looking at. That said, there's ways to manufacture returns through things like pref equity, where you're essentially adding another layer of leverage in. Now, our firm does not believe in providing pref equity or sitting behind it because we think it's just another risk form that we're not going to venture down. But many groups do, and it works for them. So is that kind of what you're getting at, or are you looking for a little something
Yeah,
else?
no, I think it's helpful just to understand the logic and the way you think about it. So you mentioned even pref equity. For those who don't know what that is essentially it's a certain amount of equity or returns that need to be hit for an investor for an investment before that operator is able to participate in the upside, right? So we have preferred returns on deals. When you're talking about pref equity, it's usually kind of almost a debt type position. So just explain that a little bit more, because you said you don't like that. And I do know that a lot of family offices or other private equity investors, they do like kind of the pref equity position. So maybe just elaborate a little bit more on, kind of that capital stack from your opinion and why you are a little more adverse to that.
Because in a typical deal we're doing, there's going to be a debt component and an equity component, and we're sitting in that equity component. When you introduce a pref layer in there, what you're really doing is going debt, pref, then equity. So if the deal were to go sideways or completely fall apart, your equity would be the last layer to pay out. On top of that, that pref equity is going to get a claim for on the next dollar after debt gets paid. So it makes you from going second in the capital stack to third if you're just the equity and not pref equity.
Yeah, and I think the thing we have to watch out for as investors is that's another layer of obligation that you have to hit right before you get those profits. And if you're an LP investor, it's important for you to understand that structure because they're going to get, paid before those limited partners get paid. And sometimes people may not fully understand that, but anytime you're in a deal with pref equity, uh, that debt obviously has to get paid first, that primary loan, then the pref equity, and then finally whatever's left over, that's the equity. That's what goes to the LP investors. And what you're saying is you prefer not to do those deal structures. You'd rather just do a deal that has regular debt, regular equity, and you're going to participate on the equity side. So you're really a partner with that operator, which is why you talked about being more of a co-GP or LP as opposed to this pref equity position. So in some ways, I know it can strengthen returns for many deals, which is why some operators do like that position because they're not getting all the equity. You're just paying kind of a flat amount. It could be 10 or 12% or something like that. But the downside is, again, that's another obligation you have to meet as an operator before your equity partners get to partake in the upside. So just one of the things you need to understand. Talk to us more about just deal structures. How do you like to structure your deals typically, and what are you looking at as far as promotes?
Yeah, we're, like talking about typically we're on the co-GP side. So we're, providing that capital and signing on the non-recourse debt and to kind of offer those services, we do typically take a portion of the promote that's paid to the operator on the back end. We typically don't get involved in, construction management fees or asset management fees that operator may get when running the day-to-day, since they are the ones that are on the ground kind of running it day-to-day. The acquisition fees as well, we typically don't take a piece of those. So we're really, we're looking for that promote kicker on the back end for our group for providing, what we provide. And the waterfalls can vary. A lot of that's driven by, as us as the GP, we're also bringing in typically a bigger LP check, and we're doing the actual underlying property waterfall discussions with them. So those can vary on, a simple preferred return and maybe one or two tiers, as you hit different IRR levels, is pretty typical structure for us. We try and simplify as much as possible. Waterfalls can get very complicated. It's just, to us, easier the better on waterfall structures.
Yep, makes a lot of sense there. When we talk about the deal structures, I think one thing for me is always that, at least what I learned starting out was that, the more complicated you make a deal, the easier it is for someone just to say no, right? If you got 7 layers and if this and that, your average person is just going to get confused and feel like you're trying to trick them. So I would say keep it relatively simple, especially starting out. If you have a deal where you feel like, you want to dangle a carrot and get paid on the back end if you execute, then that can make sense. But I think sometimes people get a little too cute with these deal structures and make them super complicated. And again, it feels like they just came straight off Wall Street and want to confuse everybody. They know all these deal structures. But what do you guys see on that front?
Oh, it's just not necessary, in my opinion. Have your preferred return, have then a simple waterfall structure after that. Maybe one additional tier, like you mentioned. If you hit like a real home run, you should get a bigger piece of that promote. So that's totally acceptable. But to have 3 tiers of waterfalls is just not. It's just not necessary, really.
No, I appreciate that.
One of the things they add too, that at the end of the day, what are we talking about? Finding good deals. So if the deal doesn't even hit the pref rate, you can have 14 hurdles after that. But if it's not in the pref rate, you're not going to get any of that windfall. So just find a good deal, keep the waterfall simple, and people will come back to you.
Yeah, I love that. From an operator standpoint, I think there are 2 big fears that they have, whenever they're talking to kind of a group like yours that's willing to bring in, a large chunk of the capital, right? You'd mentioned 95-5 split, somewhere in that range. So that's a big chunk of the capital that's needed, which is really exciting for many operators. One of the fears is that they may lose control over this deal, right? So if we're partnering together and you're bringing 95% of the capital and you're a co-GP, at any moment, you may decide, you know what, we can run this better than you. Can you talk about that fear? Is that a warranted fear? Just talk to us a little bit more about that and maybe how to protect yourself as an investor if you are in that situation.
Yeah, we typically look at the major decision, and that's what I believe you're referring to. And the JV agreement is typically, we need to protect our investors, and the way we do that is primarily through hold time. As far as running the deal itself, we know our role. Our role is providing equity and balance sheet help. So if an operator is in there doing what they say they're going to do, they're hitting their numbers, they're renovating on pace, they're keeping occupancy where it should be, we usually don't interfere. And we do that because we trust the operator to say, hey, look, the market's getting a little soft. Hey, we're going to offer some concessions here, or whatever adjustments need to be made. Because frankly, when you get into a deal, you can model these deals out, you can survey the submarket as best you can. But once that deal closes, now it's real. Now it's in your hand, and you have to operate that property. And things are going to happen. Obviously, in the last couple of years, we've seen a major change. So if you had a business plan in 2019, as soon as March of 2020 came around and COVID hit, well, that business plan went out the window because you had to change your plans and adjust on the fly. So, we get it. Things are going to happen, and we just try to be as supportive of that operator as we can.
Now, I appreciate you sharing that because I've heard the horror stories, right, of people getting kicked out of their own deals. I actually know an operator who, unfortunately for him, he got kicked out at the closing table. They basically reached out to him the night before and told him that he wasn't needed and they were gonna, cut him a little bit of a check and they were gonna just take the deal and move on. So I don't know if you've heard any stories like that or if there's anything, operators can do to protect themselves if you're going into business or a partnership with someone who's, again, signing on the loan and, bringing a lot of the capital to the table. So is there anything that you can do as an operator to maybe protect yourself in that partnership?
I would just say have a really good attorney who's done this multiple times and can point out, hey, this is where you could get tripped up, and then also just work with people that you want to work with. We definitely take an approach where we want to be able to call the operator, and have them call us, and so have a fluid conversation at any time about a property or deal.
Yep. When it comes to those key decisions, the big decisions, right? Whether or not we want to refinance, whether or not we want to sell the property, what does the process typically look like for you all when it comes to those big decisions?
I think it varies on the business strategy. I mean, we've had some exits where we've completed the full scope of the original strategy. Things are, going well, rents are where they should be. And, for that point, it's time to exit. Sometimes there's a little bit of value add we leave for the next investor. But, there are other times when, what we have a certain hold time. Mark mentioned like duration of our investment period. Our fund life is 10 years. We typically like to target that 2 to 5 year hold. But we have flexibility there. So if things, if we're, obviously things can happen in the market. So if it's not an ideal time to sell, we're not going to force sell it either. But, we look to kind of make sure that the business plan has been accomplished, or at least shown, a majority of completion, so we can put it on the market and move on to the next deal. So it's really about us just, getting our fund life, in line, which is, back to the major decisions on us having a kind of exit approvals. That's important to us, just for our investor base.
I think the key thing here as well is just one, aligning with your partners on key decisions, expectations, just like you do with any partner, right? You want to make sure they know the horizon of the deal. Do you plan on being in and out in 2, 3 years? Do you plan on being in for 7, 8, 9 years? Really important to make sure that communication is pretty clear. And then obviously things change. So maybe the valuation is shot up and you're able to hit your 10-year number in year 3. And maybe it makes sense to sell, but those are the conversations you'd have with your partners so you can make an informed decision. I know that there's a lot more we could talk about, but for folks who really want to learn more and get in touch with you to learn more whether or not this might be a fit, or maybe get some more feedback from you, they can check out your website, ctcwealthmanagement.com. And on there, you can get contact information for both Joe and for Mark. So make sure you check out their website, ctcwealthmanagement.com. Right now, we're going to go to our round of insights. Guys, all right, I'll let you guys figure out who's going to answer the questions. But the first one is, give me a failure or an apparent failure that set you up for later success.
Yeah, the one thing that we noticed early on in our funds is we were putting on longer term debt onto projects, which may or may not have needed that longer term debt. And so the one thing we learned from that is, hey, align the debt term with the project life. If the debt's too short, well, now you're at risk of getting called in or not being able to execute the whole business plan. If it's too long, at that point, you're kind of making just an applied interest rate bet if you're using fixed rate debt, which you probably don't intend to do if you're a real estate operator.
All right, give me a digital or mobile resource you recommend for your business.
I have to go with Excel, and I'm going to say that, yeah, you can add a bunch of tools that you may or may not use or may or may not need to learn, but if you just get really good at Excel, you can do a lot of modeling, and that and you'll have a better understanding of the model without bringing in a third-party tool that'll help you with valuation or other aspects of that.
Give me the book you've recommended or gifted the most in the last year.
I'll start with that one. And if my son was here, he'd kick me under the table. The book I've read and I've gifted the most recently is Life 3.0, which is basically about the growth of artificial intelligence. And it really gives really good insight into what you don't think about artificial intelligence and where that can take society. I think it's very interesting.
All right, give me a daily habit that helps you stay focused on your goals.
Obviously, the day, once you get going, it can get away from you. One thing I know Joe and I always do is in the morning, we just have a quick discussion of, hey, what are we going to work on and what do we got to get done? So it helps you keep you focused on the bigger picture by staying in a daily cash regimen.
All right. So you guys invest primarily as, co-GPs and LPs. So you're always reviewing deals and deciding whether or not you want to invest in it. So give me your number one insight for deciding which multifamily deals to invest in.
I'm gonna have to go back to what we talked about earlier. Just look for a good seller story. And there's lots out there, and you just got to keep turning over rocks till you find the project that works for you.
And yeah, I would add one thing to that is just work with people that you trust.
I love that. Great points there. All right, let's lighten the mood a little bit. You guys are in Chicago, great food town. Give me your favorite place to grab a bite to eat.
You go first, Mark. I got mine.
I'm gonna say Pequod's Pizza. You got that deep dish pizza, charred crust, couple different locations. Can't lose.
All right, I have to go Portillo's Italian beef. If you've never had a Portillo's Italian beef with giardiniera, the best.
There you go. Straight Chicago answer there. Appreciate it. Well, listen, a couple good things, from this conversation, right? So one, there's opportunities. I think a lot of times as newer emerging operators, you may have limited capital options, but as you guys just kind of proved, there are resources out there, there are groups who are looking to invest in deals. Reach out to a group like CTC Wealth Management and see if they might be able to help you kind of grow your portfolio and work with them as well, because they're looking to park money and make some money together. So it's not them doing you a favor, it's working together so you guys can grow together as a business, right? But taking that, understanding how you all analyze deals, the four things that you pay attention to are going to be the property itself, the submarket, the promote or deal structure, and then the operator. So understanding those four things, making sure you pay attention to all four of them whenever you're making a decision, and recognizing that all four are not going to be great. I mean, it's rare that you're going to find all four great. So if you can find three that are great and the fourth one is kind of good, that puts you in a good spot to make that investing decision. Again, if you all want to learn more, go to ctcwealthmanagement.com and you can reach out to Mark and Joe there. I want to thank you guys for being great guests, all Multifamily Insights. We look forward to staying in touch and talking to you again soon.
Great. Thank you.
All right.